Hi, this is Mike Maloney, and I've got a very special guest this week. His name is Ronni Stoeferle. Ronni is from a company called Incrementum that has been producing one of the most comprehensive reports on the precious metals market, specifically gold, for 13 years now. Ronni, how are you doing?
Very, very good. Good to be on
Okay.
the show. Thank you very much.
I'm going to let our listeners know why we're doing this video. You guys have a chart book that is a condensation of your In Gold We Trust report. And I've always just loved, I'm dyslexic. Reading page after page after page of stuff or looking at a table of numbers is like looking at wallpaper to me or Egyptian hieroglyphics. But when I see a chart, there's a saying in English, one picture is worth 1,000 words. And I'm fond of saying, well, if one picture is worth 1,000 words, then one chart can be worth 1,000,000 numbers. And it's exactly true. A good chart shows you exactly what's going on in just a second. You understand the direction that things are taking us. And so that's one of the reasons that we're doing this video. And the other one is, you've been following my stuff for years. I've been following your stuff for years, and we've actually never spoken before.
Yeah, that's true. That's true. So your voice sounds so familiar to me. It sounds like the voice of a close family member, because I really love hearing all your stuff, and I'm very, very thankful for all the work that you have done for the gold community, educating people about sound money. My partner, Mark Walek, who writes the In Gold We Trust report, I think is one of your biggest groupies. So I'm sad that he isn't on the call, but he will be perhaps later on. So yeah, thank you very much for your terrific work.
Well, thank you also. Anyway, let's get into your chart book here, because this is quite an amazing piece. The PDF is 70 pages long, and I'm going to skip through a little bit of it. I'm going to go right to page 6 at first, and you've got a chart that is about the everything bubble. Tell me a little bit about this chart. This is financial assets of household divided by disposable personal income.
Yes, well, we have seen that central bankers, they approached the limits of the, let's say, the monetary universe recently by touching the zero line or even going negative. But we all know that after
on interest rates, you're saying,
yes,
going negative.
yes, yes,
Which, by the way, was not even a concept until the crisis of 2008.
Yeah, I mean, yeah. Now, actually, at the moment, I think it's only 15 trillion of bonds trading at negative yields. So investors taking a guaranteed loss. I think that's we will read that in history books in a couple of years and say, what the heck were people thinking back then to waste resources on that? But coming back to that chart, I mean, it clearly shows that the previous bubbles, like the dot-com bubble, for example, valuations in other sectors besides, the dot-com space and all those technology companies weren't that extreme, and we didn't see any major overvaluation, for example, in real estate or in bond markets, in the art markets. So it was limited basically to the dot-com area. Then, of course, we have seen the dot-com bust. Then central bankers stepped in again by lowering interest rates and pretending that everything is fine. Then we blew the next bubble, the real estate bubble. Also, mainly, I would say, in the US, but it also, of course, led to severe misallocations in the banking space. We've seen, of course, Bear Stearns, Lehman Brothers, Fannie Mae, Freddie Mac, and so on. But still, having a look at other markets and other regions, I think that back then the overvaluation wasn't that severe. Of course, we know 2008, 2009, central bankers stepped in big time again, introduced something like quantitative easing. Of course, it sounds very, very sophisticated.
Easing is just a term for print currency, right? I mean, they're easing up on the quantity of currency available, basically printing a bunch of currency from nothing, counterfeiting.
Yeah, I mean, it always has to sound a bit, sophisticated, like MMT, modern monetary theory. Doesn't that sound really, really smart? We all know what it's going to be about. But coming back to that chart, Mike, now we are seeing those overvaluations and actually all-time highs, not only in the stock markets, mainly in the US stock markets, but also in bond markets. We're seeing it in real estate going crazy all over the globe, and we're seeing it in other areas like the art market, for example. If you talk to people from the wine business, for example, it's incredible how much speculative money is flowing into those small niche plays in real assets. So this time it's really an everything bubble that touches many asset classes, and that is global. And yeah, that also means that the next bust will be more extreme and will make 2008 look like a kindergarten party, probably.
I believe so also. I think that this one could get really nasty just because of all the manipulations that they've done, because every manipulation comes back to haunt them. They're just storing energy. It comes back and blows up in their face. So let's move on to page number 7 here. And you've got a chart of the inflation of the quantity of ounces of gold versus the inflation of quantity of the amount of currency on it. Now, is this U.S. currency supply or is this global M2?
No, that's M2 for the United States.
United States. Okay. So basically, it says we've gone crazy since the since the inception of the Federal Reserve. We've gone crazy.
Yeah, well, that's really it in a nutshell. But I think, it's all about relative supply curves, as Dave Rosenberg said, or about the so-called stock to flow ratio, which is really, really important for us. So actually, you can be certain that your gold will be inflated by roughly 1.5% every year. That's the
Right.
natural inflation of gold. This is the annual production relative to the total stock of gold. And this compared to monetary aggregates. Yeah.
That's the annual production compared to the stock of gold, but that includes all jewelry and artwork and artifacts and everything else above ground. So if you're comparing it to just monetary and investment gold, it would actually be a growth of about 0.75%, because about
Yes.
half gold goes into jewelry and such. So 0.75 of one. So the chart would even, if we had accounted for currency, the gap between currency production and if we had accounted for the jewelry, I mean, the gap between currency production and the growth of the monetary gold would be tremendous. In fact, gold would be the amount of monetary gold would be rising slower than the rate of population in the world. What I'm amazed at is you've got a statistic in here since 1900. The monetary aggregate, M2, has risen almost 180 times faster than annual world gold production. That's amazing.
It is, and I mean that's economics can be very easy. Only nowadays economists try to make it very complicated. But if you massively increase the supply of money, of course this will lead to rising prices or just falling purchasing power, because everything getting more expensive just means that the purchasing power of your euro and your dollar is just falling. And we're running quite a lot of charts regarding the long-term purchasing power of gold. And I think that the main takeaway is that gold perfectly preserves your purchasing power over long periods. And I think this relative supply curve of gold versus paper money, that is the main reason.
I agree. They keep on printing currency, and then every once in a while, gold catches up. And that's a rare opportunity in a person's lifetime when that happens. I want to skip down to page 11 now, because you've got a pretty scary chart here. Tell us about this recession indicator chart. It's a predictor of recessions.
Yeah, well, I mean, we know that the Federal Reserve and most economists aren't really successful in predicting recessions, and there's many examples for that. And of course, the Federal Reserve doesn't see a recession on the horizon, and all of Wall Street really doesn't see a recession coming. Although I think it changed slightly in the last couple of months, but actually the own indicators by the Federal Reserve New York showing the recession probability within the next 12 months, it's showing almost 40% chance of a recession in the next year. So
Yeah.
every time we have seen such a high level, we've already been in a pre-recession phase. Now, Mike, let's get this straight. For me, a recession is not something that you have to be scared of. It's just something very normal within an economic cycle. It is a reallocation of resources. And after recession, you can start on a much more solid basis again. But the longer you try to avoid this natural recession, it just gets worse and worse. And therefore, I think the next recession, as I've said previously, I think this will be a tough one.
Yeah, in the United States here, we used to have a policy of suppressing forest fires. I came from California, and in the West, every once in a while, we get these really bad fires. Yeah, Yosemite, and before that, Yellowstone burned. So these beautiful national parks, when we would suppress the forest fires and keep on putting them out, it created all of this underbrush and all of this dead material that was just like stocking up for the next big fire, just stockpiling fuel. And they keep on manipulating the economy. And to me, it's the exact same thing as stockpiling fuel. So this chart, though, on page 11, with how high this is, the only other times this indicator has been this high has been right at the onset of a recession or in the middle of a recession. And so I find this chart quite amazing. It goes back to 1990, and I think everybody should take a look at it. Next, I want to skip to go to the next page, page 12. A lot of people don't know when somebody talks about debt or deficit, a lot of people don't understand the difference. And the deficit is the difference between how much you take in and how much you spend. If you spend more than you take in, you've got a deficit. If you spend less, you've got a surplus. And the debt is the cumulative effect of those deficits and surpluses. If you're running more deficits than surpluses, you end up with in debt. You end up underwater. This chart shows both of them. So all of the gold area, there's that one area there's a zero line on the right-hand scale. You can see that there's a zero line, and then you've got, this is in billions of dollars, right? On the right-hand scale.
Yes.
And it shows the Clinton years surpluses. And what's interesting is if you look at the debt line, it goes flat, but it doesn't take a dip. So there's a whole bunch of hidden off-balance sheet items that they're not accounting for in here, where that surplus was just a figment of somebody's imagination in the accounting department. It didn't really exist, or you would see that debt line actually go down, because if we're running a surplus, that means we're paying down the total debt during those years. So I've always found this interesting. There's a whole bunch of hidden debt. And when I do an analysis on it, I come out, if you go back to the beginning of this chart, 1966, I did this. You take all of the deficits and surpluses and add them up, they come out to $7 trillion less than the change in national debt during that time. So I call it the $7 trillion lie. So, but this is a very good chart, just showing you that the government has gone insane. What I find also is that when they make a prediction going forward, it's always this rosy prediction. And here, the prediction that they're making is for close to $1.5 trillion deficits out toward 2027, 2028, I guess that is. I have a feeling we're going to be hitting those just within the next couple of years here, especially because see, they're not predicting a recession until 2028. They think we're just going to have this rosy scenario for another 9 years.
Yeah, well, I think those CBO forecasts, they're a bit too optimistic. They see for the next 10 years, as you've said, no recession and growth by real growth by 3% annually. That's pretty optimistic.
And it's a fantasy.
And I can remember you see this small period of surpluses in the Clinton area, and I remember actually back then the big discussion was, we are running out of US debt. What shall we do if this continues? And I just watched, I don't know why, but I watched a campaign discussion for the 1996 presidential election, Ross Perot versus Bill Clinton. And actually, budget deficits and how to further reduce the deficits and get the economy and the debt situation back in shape. This was the major discussion point. I mean, that the whole election was about that. If you compare it to nowadays, at least on the surface, the US economy is doing still pretty well. US is running deficits above 1 trillion. And, even the Republican president doesn't care about the debt situation and coming back to a more conservative policy. I mean, the Democrats, of course, I think the big topic nowadays for Elizabeth Warren, of course, is something like MMT, basically handing out everything for free, a Green New Deal, free tuition, free healthcare, whatever. So I just want to emphasize that the discussions nowadays compared to like 20 years ago are completely different, and nobody cares about those debt numbers anymore. But of course, at some point they will. And we bought lots of time by lowering interest rates. And of course, the debt service or the interest service got smaller and smaller. But at some point, you will have financed all your debt with very low interest rates, like the Japanese did. And then you're just getting very, very sensitive and, let's say, fragile when it comes to even tiny moves in interest rates. So it is obvious we're caught in the zero interest rate trap.
Yeah, I want to say that I loved Ross Perot, and some people are going to think I'm nuts, but I actually voted for Ross Perot. He was the only guy that has ever shown up with charts. He would come to a debate with these giant charts that he had enlarged and show people what the budget deficit was, teach people what the debt was. I loved it. And then, when you talked about Republicans versus Democrats, Republicans are supposed to be fiscally conservative, yet it was during the Reagan administration that they said that deficits don't matter. Last year, when we were getting to the point where we were about to become the longest economic expansion in U.S. history, we did tax cuts, which increases the deficit. If you don't have as much income and you're still spending the same, you're going to have a bigger deficit. So that increases the deficit and the debt as we were getting toward becoming the longest economic expansion in history, which we are now in. So it was a stimulus at what would normally be the end of the cycle, not the beginning of the cycle. Anyway, I want to wrap up this segment right now. I want to let all of our viewers know that this is just one of a series of videos that we're going to be doing. And I want to let everybody know to please go to Incrementum's website. There's going to be a link below the video here. Download this chart book. It's fascinating. It's all captioned, so you get the executive summary. You're getting basically the conclusion of the big In Gold We Trust report. Is the In Gold We Trust report available to everyone, Ronnie?
Yes, absolutely. It is available for free. All 13 editions are available for free on our webpage in German, in English, but also in Mandarin. Starting this year, we published it the first time in China because it obviously is a very, very important gold market. And for us, it's important to get the word out about sound money. Everybody is talking about environmentalism and sustainability and so on, and everybody thinks that he's so green. But I think it's important to talk about the sustainability of our monetary system as well, and about sound money. And this is basically the mission that we're on, and therefore we try to explain stuff that is going on, put it in a historical context, and also provide solutions.
Thank you very much for listening, and thank you, Ronnie, for being here.
Dankeschön. Thank you very much.
We'll see you next time.